Nvidia reported earnings yesterday. Many had their doubts that they could continue their explosive growth. However, they crushed earnings and the stock surged almost 10%, reaching a price of 1,000 for the first time. Nvidia has become the poster child for the AI revolution, and therefore everyone wants a piece. Today we're going to look at the earnings report, the fundamentals of the company, and we're also going to compare it to some competitors like AMD and Intel. So starting off with this article, we can see that Nvidia shares passed 1,000 for the first time. So really what I want to get out of this is the top line metrics here. So we'll scroll down. So earnings per share, right? So they came in at $6.12 adjusted versus $5.59. So they beat that by a substantial margin, right? And the same on revenue. So they were expecting 24.65. I think Nvidia had put down about 25 billion, but they actually hit 26, which is, immense growth. We can also scroll down here. We can see there was a couple of other updates. So a lot of this is just, their data center category rose by 427%, which is their largest sector. If we scroll down a little bit more here, what we want to see here. Yeah, so right here. So there was a buyback of 7.7 billion worth of shares, and they paid a 98 million dividends during this quarter, right? They also announced an increase of 4 cents per share to 10 cents on a pre-split basis, because they announced a 10-to-1 split as well, or a stock share on the existing stock. So that was kind of the headlines of the article. I'm going to pop over now to the report to look at some of the graphics. So this is Nvidia's earnings report. So they had a couple of slides here. So really what I want to look at here is also the revenue again of how it scaled. Like, so if we go back to FY20, right, they had almost 11 billion in revenue, and that surged massively in FY24 to almost 61. And we can see now for just the first quarter of FY25, which is this year, they had 26, which is almost the entirety of FY23, which is just crazy in one quarter, right? So, if they keep that up, they'll have over 100 billion in revenue. We can also see some of their breakdown of the sectors here. We can see, gaming, data center, 87% is the largest amount. Gaming, 10%. Now, there were a couple of small things that actually contracted, which is, kind of to be expected when they're going all in on data center. Gaming contracted, the automotive sector contracted as well, but I think they're still very competitive, for example, with their GPUs, the GTX, which I have in the PC I have here. So they're very competitive here. If we come down here to the next slide, we can also see the gross margins are very solid as well. We've almost 79% growth. Coming down here to strong cash flow as well. So we can see they had a massive amount of cash flow last year as well, and they're continuing this massive amount of cash flow in FY25. And they had the share repurchase, which we talked about in the last piece as well. Kind of a few more breakdowns on the their platforms as a glance here. So as we touched on, now these are FY24 metrics, by the way. So data center grew from 78, I think it was up to 80 something, right? And then gaming was 17%, professional visualization was 3%, automotive was 2%, right? So again, we can see the data center is the bulk of their revenue. We come down here to the next one, we can also see just the data center revenue growth, right? We can see again that it's literally bigger than the entire year last year, or FY23, apologies, in just the first quarter of this year. So it's really crazy metrics here. One kind of side point as well, and if you watch the earnings call, you might have noticed this, and you'll get it here anyway, is they announced their kind of new Blackwell chip, which they're hoping to kind of mass produce by the end of this year, which will also be a massive driver for their business. We also see companies like Amazon, and I think Tesla were talking about it as well, that they were going to wait till the next chip because it's just going to be so much more advanced than the existing chip before making purchases. So we'll see a large increase there as well, probably towards the end of the year. One side thing that I saw a lot of people weren't really talking about in these kind of videos is gaming. They were all talking about the data center, right? But anyone who is a gamer will also know that their GPUs are really good. They have a number one market position in gaming, right? Even though it's only 10% of their revenue, they're with their GPUs, they're beating out all the competition with their CPUs versus AMD and Intel. They're also kind of doing very well there as well, which might grow into that sector. So that was one thing. Now, their actual revenue from gaming was down, and I would probably equate that to more focus on the data centers. So the last thing in the earnings report that I wanted to touch on is they kind of had one of these slides towards the end, which was a 1 trillion long-term available market opportunity, where they're really kind of setting out how they're going to grow their business, where they reckon their gaming is going to be 100 billion, their data center is going up to 300 billion, their cloud is growing, their autonomous vehicles. Jensen Huang, who's the CEO and one of the co-founders, I believe, of Nvidia, mentioned how Tesla is probably the leading person for the autonomous driving, and that Nvidia is, potentially going to have a partnership with them so they can drive that towards growth. Which, I saw Elon on Twitter said, thanks Jensen for mentioning this, which also kind of gave a boost to Tesla. So what we're going to do now is we're going to pop over and look at the fundamentals of Nvidia itself. The chart here for Nvidia, so they reported earnings yesterday, which was the 22nd, and now it's the 23rd when I'm making this video. You can see they're at about 934. Since then, they popped up to 1,038, and you can see it's kind of fluctuating a bit here, right? So it's almost a 10% increase since they reported earnings. Not as big as, say, when they reported earnings last time, where it went up many multiples of this. If we go to the max here, you can see from even, we're going to go to the start of last year, they were like 168, and now it's like 1,040. So what I would say about that, though, is price-wise, that's kind of, you would almost say that's a bubble, right? But they're meeting their earnings expectations and their revenue. So who knows, right? It's important to note as well, right? They are the poster child of this AI revolution. When they go up, it's kind of like, a rising tide lifts all ships. A lot of other companies, tech companies, Tesla, Apple, they're all rising because of this, because they see the potential of AI. So if we come down here and let's start looking at some of their fundamentals. So their key ratio, I think they're the third largest now by market cap at 2.35 trillion. And then their revenue is 61 billion. So as we saw there, with the first year, it was 26 billion. If they continue that, it's going to be 100 billion by the end of the year, which is going to be an absolutely stellar year. But I guess that begs the question, right? Can they maintain that throughout the year? Their growth has been explosive, up 400% in some areas, 200% in others. It's kind of crazy. Now, they did announce that dividend. Their dividend is, it's nothing to write home about. It's, 0.02. It was a slight increase compared to what they had announced earlier. One thing that kind of catches my eye here, right, is their PE is almost 80. It does depend on the industry, but typically between 20 and 30, maybe even, 35, we'd be like, that's a pretty good PE, maybe it's priced according to the earnings. However, 80, you can see compared to earnings, the share price of over 1,000 is quite high. So, is it a good time to buy? I wouldn't exactly say so. So let's look at some more of their metrics here. So I'm going to move straight over to financial strength. Looking at their current ratio, which is their current assets and current liabilities, 4.17. It's not amazing, but it's not terrible either. Their quick ratio, which is essentially their assets and liabilities, but adding in their inventory, not amazing either, but not too much, not too crazy. Their payout, which is the percentage of their paying out in dividend, is only 1.33%. So, I mean, that's pretty amazing, but the dividend's really low. Their cash flow as well up the top here at 26.6 billion is very attractive. I think we'll move over to the margins here now. So starting with their gross margin. So trailing 12 months with 72.72%. That's very decent. The growth in that was almost 70%. That is incredible. Their net margin trailing 12 months was almost 50%. That's very good. And their over the last 5 years was almost 35%. So essentially, for every 100%, 35% of that is a net profit, which is almost 40%, which is very good. Their operating margin, pretty solid there. Cash flow, all good. Looking at their growth, right? So I expect really this is probably going to be quite large. So if we look at their revenue per share growth over the last 5 years, 40%, that's very good. Over 5 years, just revenue, 54% is amazing. Their EPS growth over 3 years of 51%, 5 years, 90%. That's one of the highest I've ever seen. 90%, almost 91% is crazy. EBITDA, I'm not a great fan of that metric. Net profit margin over 5 years is growing almost 10%. That's solid. Their dividend yield, let's not really look at there because their dividend yield is so low. I don't think you're buying the stock for the dividend. It's just kind of a small little bonus. So if we go to their financials now, starting with their income statement. So let's close a few of these off and go back to 2021. So their net income in 2021 was 4.33, went up to almost double to 10 almost in 2022, back down to 4.37 in 2023, and then up to 30, right? In 2024, which is amazing. If we look at this quarterly, I think this should have the new one as well. So in the last quarter of last year, it was 1.41, and then it's up to 2. So on the quarter, it's pretty good as well. Popping over to the balance sheet, let's close a few of these off. So let's look at their assets first. So what I'm looking at is are they growing here? So we had almost 29 in 2021, doubled in 2022 to 44, 41, and then massive gains again, 65 in 2024. If we look at the same in their total liabilities, so we had almost 12 in 2021, 17 and a half, 19. So look, their liabilities are growing as well, which is to be expected alongside their assets, but the asset growth is much larger. What we would really look at here, or what I would look at, is like their debt to assets ratio. So their total assets was 65, we'll say 66 billion, right? And then their debt was 9. So, or we'll round that to 10. So they can essentially pay off, if they were to go bust in the morning with their assets, they could pay it off like 6.5 times over. So that's a very positive sign. Let's go to cash flow. First, let's look at just the net change. So we had minus 10 in 21, 1, 1.4, and then 3. Really, the best metric here is the operating. So the cash flow they're producing in the general operations of the business. So we had 6 billion in 2021, 2022 we had 9, 5 in 2023, and then 28. So they're cranking out cash here. So that's probably why they did a share buyback in the previous quarter. So let's move over and look at some of their competitors now. I think these metrics are very positive. The only thing I'm calling out is the PE is quite large, being at 80. So if you're looking to buy Nvidia, is the price too high at the moment, is the question you should be asking yourselves. So the first competitor I'm going to look at is AMD, so Advanced Micro Devices. And kind of a funny tidbit here is the CEO of AMD, I believe, is actually a cousin of Jensen Huang, which is, kind of funny. So looking at their price, it'd be interesting. They're up as well, right? So it's kind of that thing again where, rising tide raises all ships. But obviously their valuation is much lower than Nvidia. Nvidia is the one who's driving all this growth in the kind of AI revolution. So if we come down here, so their market cap is, it's like, what, 1/8, even less of Nvidia's. Their revenue is pretty solid, 22. They don't pay any dividend. Now again, their PE rate, this is a crazy PE ratio. As I was saying, between 20 and 30 is usually typically what you go for. So that's crazy. I'm not really sure what's going on with that one. Let's look at some of their ratios. So we have financial strength here. So their free cash flow, almost 1.2 billion, pretty positive. Current ratio and quick ratios are much lower than Nvidia's, pretty solid. They don't have a payout ratio because they don't pay out dividend. Gross margin over the last 5 years is 45%. That's solid. Net profit margin over the last 5 years is 10%. So, some growth there, not amazing. Operating margin has grown almost 10% over the last 10 years as well. If we look at their growth, so revenue, 3 years, almost 28%. 5 years, 32%. That's solid. Per share growth, almost 20%. That's solid as well. EPS growth over 3 years, almost 10%. 5 years here, we can see they must have had a pretty bad year or something in between. So the EPS growth isn't amazing altogether. EBITDA, don't look at net profit. You see net profit margin is in the negative here as well. So that would be a red flag for me to try and find out what is going on with that. Let's look at some of their financials. So let's close a few of these off and go to 2021. So their net income, 2021 was 3.16, 1.32 in 2022. So that's a very big drop. And then 2023 dropped again. So it does seem like these guys are actually going the wrong way. The growth isn't there. So I would definitely call that out as a red flag. If we go to their balance sheet and close a few of these off. So if we're looking at their assets first, so 12.42, Oh yeah, they had a massive jump there. Maybe they acquired something of almost 50 billion, and then a little jump then from 2023, and their liabilities in the same time grew on par, very little really compared to that asset gain. So if we look at 2023 here again, and we want to look at their debt to assets, so their debt was 2.5 and their assets was 50. So, essentially they could pay off, their debt here about 30 times over. So that's very positive. Cash flow, closing these off. So if we go to 2021, 940, 2.3, and a negative. So negative is definitely a red flag there. It did grow from 21 to 22. So that's positive. If we look at their operating, we can see they are cranking out substantial amounts of cash, 3.52, 3.57, but there's a substantial drop off here though, of almost 2 billion. So that'd be another red flag. The last one I want to look at, I was expecting more from AMD, I will say, I'll be honest, is Intel, which is a stock that I used to own, and I actually sold it for a 40% return on it because I thought it was going down, which is, as you can see from the chart, it has. I believe I sold it, it was up around 40 or something, and now it's down to 30. So yeah, Intel is a bit of a weird one. I think the main thing that happened here is lack of innovation is the first thing. They can't compete, their products aren't as good as the competition like AMD, etc., Nvidia. And the CHIP Act is kind of artificially inflating them, and even with that they didn't get as much in the CHIP Act as they thought they were going to get. So like there was TSMC got a lot, Samsung got some, Qualcomm, Micro got some, so but they did get the lion's share, I will say that. So if we look at these metrics coming down here, so quite a large company as well, but the smallest of the three, obviously. Revenue 54, market cap 136. They do have a dividend yield. They used to have a very good dividend yield, but they cut it because they weren't really able to keep up with it. Again, with the PE ratio, ironically, they have the best PE ratio out of the Nvidia and AMD at 54, but still outside that kind of 20 to 35. So if we look at their ratios here and pop over to financial strength, free cash flow in the massive in the negative, right? So this is one of the reasons I sold it as well, and I'm probably going to do a separate video on this. But to explain this is they're doing a lot of investing into foundries at the moment. They're kind of moving over to a foundry business, so that will explain some of the metrics as we go through here. So their current ratio positive, quick ratio very good, payout ratio. So you can see here, that's why they cut the dividend, right? So they had a payout ratio of 182%, which is completely unsustainable. So they cut it down to a payout ratio of almost 40%, which is probably sustainable. If you look at their margins, so gross margin over the last 5 years has grown 51%. Net margin 20, that's actually pretty positive, which I'm kind of surprised at. Their operating margin grew as well. And if we pop over to their growth here, so revenue, down 11% over 5 years, down 5% in 3 years. EPS down as well, massively. Another reason why I cut them off. And if we scroll down here, net profit down almost 40%, and their dividend yield, because they cut, is down as well. So out of the three companies, Nvidia's fundamentals at the best, but their price is crazy high at the moment. AMD, something has clearly happened over the last 2 years that has caused their stock to go down substantially. Intel is a bit of a dumpster fire, right? Because if their investment into these foundries don't pay off, I could actually see them going out of business. They don't have the innovation like Nvidia and AMD. Their competitors, especially AMD, with their Ryzen chips, are just destroying Intel. And they didn't get as much in the CHIP Act, but they're being artificially propped up by that CHIP Act. So their value is probably kind of misleading. Hence why I sold it. Long term, they're down a lot. Potentially, if they turn things around, it could be a good investment, but who knows? But that's going to finish up the video today. So thanks for watching, and I'll catch you in the next one.